If I told you that more homes this week went into contract than last year at this time, would that surprise you? How can that be? Well, these are both supply constrained markets. So while the overall demand is obviously much lower this year, there are still fewer homes on the market than we have demand for. So inventory fell again this week as a result. This is not a story of too much demand. In fact, two of the three home price leading indicators that we're tracking here are down year over year, negative home price appreciation. We have some demand, but consumers are obviously very price sensitive. And we can see the sales pace, though, ticking up nonetheless. Ticking up from last fall's total shutdown time. Every week, of course, Altos Research tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, and all the changes in that data, and we make it available to you before you see it in the traditional channels. The data we cover here in these videos is national in scope, but it is available from Altos for every zip code in the US. If you need to communicate with buyers and sellers about the market, there is a link to join us in the description below so you can dive right in. I'm Mike Simonsen. I'm the founder of Altos Research. And here's what we know for the start of March 2023. Inventory of single-family homes available on the market fell by 2.5% this week, yet again. As we have more buyers than sellers, even as we roll into springtime. So there are now 418,000 single-family homes on the market. The last time inventory was this low was back in June of last year. This week, a year ago, the first Friday of March, was the absolute low point for inventory with only 241,000 single-family homes on the market at that time. So there are now 73% more homes on the market than last year at this time. But the difference between the years is actually about to start shrinking. So remember that we have 49% fewer homes on the market than we did in 2019 before the pandemic. By March last year, interest rates had started climbing to 4% and higher, and then buyers slowed dramatically. So at the same time, would-be sellers last year were trying to get listed before rates jumped even higher. So inventory started building very quickly after that early March low point. By June, inventory had crossed over the 400,000 level and was rising very quickly each week. So we're now on the other side of that slope. You can see at the right end of the chart. Each week, we'll now see smaller and smaller difference over last year's inventory. Last year, it was rising swiftly. This year's still declining. Inventory in normal years would be climbing each week now, of course, as the best new inventory gets listed for the spring buying season. But with a 2.5% drop this week, that trend hasn't even slowed yet, let alone reversed. So that says to me we have a few more weeks of inventory declines, maybe drops by 1%, then 0.5% before turning flat and rising in April. I've said this before, but there is no indication of any inventory surge to the market coming from anywhere. So there are a lot of guesses where future inventory might come from. Recession, big job losses, investors panicking, but none of those is here yet. And this is important because it's going to be really hard for the most dire predictions for home price collapse that are out there. It's going to be hard for those to happen this year when supply is so restricted. We are starting to see some more new listings each week, even though the total new listing rate is still at very low levels. There are just very few sellers each week. This week, a total of 68,000 new listings, with 18,000 of those going into contract essentially immediately. That's single-family homes. Last year, it was 74,000 new listings, with 24,000 going into contract immediately. So in this chart, each bar is a week with a total count of new listings. The light portion of the bar are those that go into contract essentially immediately after listing, just a couple days. We call those the immediate sales. And you can see how the last bar on the right has a nice jump this week in both the listing volume and the immediate sales, but it still shows us fewer sellers than even last year. So it's wild to me that in this 7% interest rate environment, we have 18,000 immediate sales this week. But I was talking to a friend this week whose dream home became available, and he found himself in an over-asking competitive bid process with 3 other potential buyers. The right home, priced right, I guess is sort of an always rare thing, and it goes quickly. This week, though, there are 7% fewer new listings than last year, and at this pace, we just won't have inventory build up until something else changes. Some big economic change, perhaps. By the way, next week, Wednesday, March 15th at 10 a.m. Pacific, we will have our monthly webinar where we dive into all the details on the active market. So we'll take an hour to look at all the leading indicators, like these new listing rates. We'll have an hour, our latest forecast for inventory for the year, and lots of local market data. If you need to communicate to people, to buyers and sellers, about what's happening in the market, you should join us. The link to register for that webinar is in the description below, so click that and join us Wednesday. You can indeed see the market slowdown in the indicators of home prices. So 2 of the 3 home price leading indicators that we track are lower than last year at this time. So that actually is probably helping demand, a little bit more affordability. The median price of the new listings this week is $389,900. Last year, it was $399,000. So that's the light red line here. Last year, the sellers were leaning into the momentum and prices were still rising very quickly. This year, that momentum is gone, of course, and prices are going sideways. The median price of single-family homes in the U.S. is $424,999 this week. It's actually up a fraction of percent from last week. As prices trend to cluster around the big round numbers, in this case 425,000, I anticipate that we'll have several more weeks around this price point. And each week, though, the year-over-year price gains get smaller because last year the prices were climbing so quickly, and you can see the much lower slope of the dark red line this spring at the right end of the chart. And this is important to note because home prices are not falling, but the comparison from last year is getting worse. Last year, prices were rising much more rapidly each week. And this tells us, of course, that consumers are sensitive to affordability, but that they are still buying houses. In other words, there's no evidence of any crash in home prices happening. Last fall, it looked like there could be, but the facts each week keep dispelling those dire predictions. But as I've mentioned before, we can see that the headlines will probably start showing negative year-over-year home price change in the coming months. So you'll start seeing home prices are falling. Later in the year, if big recession hits with big job losses, like that would be a risk that could slow housing even more dramatically from here. It is kind of surprising, but when we look at the sales rate this week, there were actually more homes that went into contract than last year at this time. 69,000 newly pendings this week versus 68,000 last year, single-family homes. As I mentioned, both of those markets are supply constrained. So last year, if there were more for sale, we'd have a lot more sales. This year, if there were more on the market, we maybe have a few more sales. So in this chart, each bar is a week with the total count of new homes in contract, the pendings that week. The light portion of the bar are those newly in contract in a given week. At the right end of the chart, you can see this week's light portion starts to get bigger. More sales happening. This is the first time in a long time we've had more new contracts than a year ago. So we have 20% fewer homes in the pending process than we did at that time last year. 326,000 now versus 404,000 then. Obviously, a dramatically slower market in the second half of the year got us where we are. But enough is happening now that sales are ticking up. We can indeed see the spring market taking shape with the price reductions data. So we're likely at a low point for the year with 31% of the homes on the market having had a recent price cut. That's just a tiny fraction lower than last week. As we go later into the second quarter, the homes that didn't sell yet start taking a price cut. And so this number starts climbing in the next few weeks. The price reductions show us, again, that the market is not tanking from here. Notice how this year's dark red line here is higher than recent years, but is not falling and is actually in a pretty normal range. If buyers were still scarce, we'd have more price cuts, and the data just doesn't support that narrative. You know, with these videos, we focus on the whole U.S., but many local markets are behaving differently. And so next Wednesday, March 15th at 10 a.m. Pacific, we'll have our hour-long webinar where we dive into a bunch of the local markets. We spend time looking at what we can already see and what we can expect for the rest of the year. These webinars are limited to 1,000 attendees, and each month we get far more than that who want to join. So you need to reserve your spot, and to do so, click the link in the description below. Reserve your spot now and join us next Wednesday at 10 a.m. Pacific for the super detail. At Altos, of course, we track every home for sale in the country every week. We cover every zip code in the U.S. If you need to look at your local market right now, if you need to communicate with your buyers and sellers right now, go to altosresearch.com and book a free consult with our team. We will help you interpret the crazy market data for your clients right now. It's a critical time to be properly informed about the market. More next week.